At this point in the modern age, everyone has heard about cryptocurrency. Even farmers from the remotest parts of Asia have made life-changing investments that lifted them up from poverty. But what does having crypto really mean? And what traits does the cryptoverse have that make it so valuable? Welcome to Crypto Addict, where we deliver you everything crypto at your convenience and comfort. Today, we'll be looking at the advantages of making crypto a part of your investment portfolio. The initial and ultimate goal of the modern cryptocurrency models is decentralization. The very first developers thought of a project that could take the power and especially the influence of elites that are in control of trades based on fiat money. This was first realized when the legendary developer under the alias Satoshi Nakamoto invented Bitcoin, the coin that spearheaded the rise of the whole cryptocurrency industry and took the world by storm. Further innovations led to the creation of Ethereum, which utilizes smart contracts that only operate when certain conditions have been met. This in turn led to the creation of NFTs or non-fungible tokens, which are currently traded and collected at astronomical prices. Of course, there are a ton of other cryptocurrencies out there, and some even use the very thing cryptocurrency was meant to fight against and ultimately take over: fiat money. There are a ton of things that need to be discussed and delved into when it comes to the cryptocurrencies. But wherever future innovations take it, one thing is for sure: cryptocurrencies are an investment portfolio must-have. Now, before anything else, please remember that this is not financial advice but solely our fact-based opinion. We strongly urge you to do your own research before dealing, trading, or buying any cryptocurrencies. Knowledge is your greatest asset, so invest in it first. Here are some of the reasons why cryptocurrencies are such a good investment. Number 1. Security. The level of security that different cryptocurrencies offer to everyday traders and investors is simply unattainable by other means of trade. Because cryptocurrencies are basically founded on blockchain technology, they are way harder to hack than other assets you might think are already safe. The decentralized system makes it impractical for a single person or even a group. Individuals who actually control the entire cryptoverse, or even just parts of it, by the disbursement of data throughout a worldwide computer network. It is also safer than any other kind of asset, as there is no bank involved in every transaction. There are crypto exchanges or intermediaries, but all they really do is facilitate the exchanges of maker to taker, or seller to the buyer. Now, here comes the risk part. The only real threat to your crypto assets is first and foremost human error, and the ever-present fraudulent institutions that try to get rich through exploitation of others' ignorance of the whole cryptoverse, or complete lack of knowledge thereof. There are cases of people losing the passwords of their crypto wallets. One such case even lost someone hundreds of bitcoins, which translates to more than $6 million worth of assets when Bitcoin reached its all-time high back in April 2021. Imagine the desperate feeling of trying to access a wallet worth $6 million. But no matter how hard you try, you just can't. The security that cryptocurrency brings could be a double-edged sword if you are not careful with your assets. Because of this infamous event in the crypto world, people look for ways to protect such valuable pieces of data, which expose them to other human errors. One solution people thought of was dividing and writing parts of their keys, encryption or passwords, on different pieces of papers, and keeping them in separate locations. It is a pretty effective way to secure your data from an environment where the threat of the next big hack is ever present. But then again, humans. As secure as this method is, owners of such data oftentimes lose these pieces of paper. Now we go to fraud. One of the major reasons that the cryptoverse experiences the occasional crypto winter, where almost all crypto assets see a decline of varying degrees. And we're sure you've heard of all the latest about the FTX fiasco that's been going on, where the developer Sam Bankman-Fried still walks around freely by just paying a messy amount of bail money compared to the billions of assets lost because of FTX. Besides all that, cryptocurrencies are still the overall king of assets when it comes to security. And the fact that they are not at all affected by inflation elsewhere adds to the security of your assets. That is due to the fact that most cryptocurrencies out in the market have a finite supply, not like fiat currencies that can be printed into oblivion. If you want to know more about that, just look up the Venezuelan bolivar, where $1 amounts to millions. Number 2. Returns. Let's be honest, security is a good place to start when developing a system, product, or something entirely new. But what really pulls people into basically anything available in the markets are the returns. And when it comes to returns, cryptocurrency is king. From the veteran coins Bitcoin and Ethereum, which saw a rise in the thousands of percent from their initial places, to fairly new cryptocurrencies being developed, the returns are simply astronomical. And though market volatility is still a factor to consider at times, investors return to crypto whatever the current market situation may be. You really can't blame them, especially when one cryptocurrency even saw a rise of more than 50,000%. If you invested $1,000 from its infancy stage, you'd have millions today. But with great opportunity comes great risks as well. There are a lot of pump and dump schemes in the market, so the best protection against such risks is to know your stuff before investing in anything. Even then, it's best to remember that the cryptocurrency markets can be unstable at times, and there will always be the risk of losing everything you have in just a blink of an eye. A good practice for investors and traders is to not put more than 5 to 10% of their total assets into one cryptocurrency. That's so if one fails, you'd still have the majority of your assets, enough for you to make a comeback and gain back your losses. Number 3. Diversification. Cryptocurrencies are a great way to broaden your investment profile. Due to the fact that most investors allocate a small segment of their portfolio to alternative assets, cryptocurrencies can be a great method of investing in this asset class. Having this diversified investment means that you have a certain level of protection when all the other, more conventional asset values drop. And despite the crypto market's near decade of availability to the market, experts believe the whole cryptoverse is in its infancy stage. Meaning, even though there's a current crypto winter, the cryptoverse would still see a rise in the upcoming future. If you focus on long-term investments, then look no more. The world of cryptocurrencies would surely bring about a rise in your investment portfolio. Just make sure to do extensive research on any of the new coins you choose to invest in. Number 4. Accessibility. Since the inception of modern-day trading, people have had a problem engaging in unconventional assets. There's still a stigma on people investing on their own, even when it comes to conventional assets. And that's a surprising fact, given the amount of development that different innovations have brought to the market. Cryptocurrencies have taken an extra step, however. Anyone with access to an internet connection could basically engage, trade, and invest in crypto. And investing in crypto could be as easy as clicking a button. The first thing crypto offered was the ease of setting up an online account, without KYCs that another institution asks of their potential clients. This makes crypto the perfect place to start investing for beginners and veterans alike. Number 5. Volatility. The last and perhaps the thing that causes most people to stay away from cryptocurrencies is the volatility. But to fail to see that this too could be a good thing as well. It is favorable since it presents more opportunities for profit. Prices may fluctuate swiftly, giving investors a chance to make additional profits immediately. There are different scenarios in both crypto and conventional asset markets that could play out differently from one another, meaning a certain trade or investment practice could give you gains on the crypto market but still translate to a loss when it comes to conventional investments. This is largely due to the fact that cryptocurrencies aren't regulated by conventional financial laws and regulations. This makes them an ideal environment for any and all types of investors worldwide. What's more is that it is timeless and available 24/7 all year round. Prices might increase and decrease at the same time. Because of this, there is a greater risk involved. However, cryptocurrencies can be a terrific investment for anyone willing to take on some risk. The bigger the risk, the higher the reward, right? After hearing all of these, know that cryptocurrency is really in its infancy stage. And if the infancy stage could already potentially earn you millions, imagine what more it could offer in the near future. That's all for today. Leave a like and subscribe to Crypto Addict so you won't miss out on any of our videos next time.